Welcome back. I'm Tim Rosen. This is Investing Success Video Short. It's important for investing success that your expectations be appropriate and reasonable. If you're investing and you expect that your portfolio will do nothing but gradually go up, you're going to be disappointed, and that's not an appropriate expectation. Using the example of the Matson Money free market portfolio, the 50-50 mix, that means you have 50% equities, stocks in over 45 countries, and 50% fixed income. We can know what to expect. And here's a chart, and we call it the vortex. And you see in the very first year, there's a huge spread, and that is your volatility. We can expect that this portfolio mix could go as high in the first 1 or 2 years as 28%. And you wouldn't complain about that. But we also need to expect, because of the opportunities that volatility provides, that it could go down to 10 or 12%. So if you get a statement and you see that you're down 8 or 10%, don't be discouraged. This is part of the expectation. But look what happens after the next couple of years. Year 2, year 3, your downside average expected volatility decreases and actually goes closer to 0. This red line across the middle is the long-term expected return for this portfolio. Since 1973 to 2011, the assets that are in your portfolio in this example is expected to give you a long-term return of 8.64% after fees. And to get that return, we endure some volatility. But again, the disciplined investor is rewarded after a couple of years. And what's going on with these lines here? They're getting closer and closer to your average. You don't want to be this guy who gets frustrated when his portfolio gets volatile and he changes his mind and he changes his portfolio all over again. And you see what happens is you increase and you start all over with that wide volatility. You don't want to do that. As Dalbar studies have indicated that the S&P during that same period of time, actually 1992 to 2011, the S&P averaged 7.81%, but the average investor, because of changing their mind and only holding their holdings and their particular portfolio for average of 3.2 years, their return's only 3.49%. You don't want to be that imprudent investor that keeps changing their portfolio and starts chasing other fund returns and is imprudent. You're rewarded for staying prudent, and now we can have the appropriate expectations.